Their accounting 1800 students. I want to talk about material that will be on exam 2, and it's a continuation of exam 1 actually, and it goes beyond exam 1 of course. And so I'm going to go over some things rather than go over some of the homework problems. I thought it best to go over a previous type of exam to show you not only what to expect, but also to go over the information in chapters 3 and 4 that we're going to cover, or that you should be covering. What you see here is an Excel spreadsheet in which I have already, let's assume that the journal entries, the original journal entries, have already been made. And now they've been posted to the T accounts. So, the cash balance is $37,092. This is accounts receivable. So, in other words, cash must have been debited for this amount. You have accounts receivable debited for that amount. There's a notes receivable. This is our prepaid supplies, prepaid insurance. A building was purchased for that amount. Then we got accumulated depreciation. Don't forget, accumulated depreciation is a contra account, and that is the depreciation is captured in that account as opposed to reducing the building directly. And then, of course, there's land. Then you have your liabilities. We have actually 4 liability accounts: accounts payable, unearned income, salaries payable there, nothing there yet, notes payable, and then you have your capital accounts, your withdrawals, along with the capital account. Don't forget the withdrawals are debit balance. And we have our income statement accounts: consulting services, miscellaneous income, and then you got our expenses, okay? So the first part, which is not shown here, is that the journal entries have been made, the appropriate journal entries have been made, and they've been posted to the ledger, or posted to the general ledger, or in this case, posted to the T accounts. So now, the end of the month has arrived, and now adjusting entries have to be made. Okay? See, these entries here and posting occur during the month. Now we have to make some adjusting entries that we talked about in chapters 3 and 4. And so let's click on that tab. And it says adjusting data for the month ended 31 May 2019. Record the following adjustments and post to the T accounts. Number 1, $1,893 worth of office supplies remain. Okay, what do we start out with? Well, let's go back to the T accounts before adjustments. You look at the prepaid supplies. So apparently supplies were debited for $5,603, and either accounts payable or cash was credited. Probably accounts payable, because cash is no credit balance here. So this is the original amount during the month of prepaid supplies that were purchased. $5,603. At the end of the month, $1,893 remain. So if you start out with $5,603 and you end up with $1,893 left, you must have used the difference. And the difference is $3,710. You must have used that much. You start out with $5,603. You end up with $1,893, so you must have used $3,710. So the adjusting entry is what you see here, folks. This is the adjusting entry. You debit supplies expense, and you're going to credit prepaid supplies, thereby reducing it by that amount. So if you reduce it by that amount, you're going to have this much remaining, $1,893. Okay, you need to record the amount that was used, not the amount that was remaining. Students often make the mistake, they'll debit supplies expense $1,893. No, you record what was used or what has expired. Sometimes you hear the term expired, means used. Okay? Second entry, $15,094 worth of prepaid insurance has expired. Now we don't have to figure out how much was used. This tells you $15,094 worth of insurance was expired or used. So you debit insurance expense, you credit prepaid insurance. Let's go back. How much insurance was originally purchased? Let's go back to the original T accounts, and you see $21,945 worth of insurance was purchased, and this much was used, $15,094. You debit insurance expense, you credit prepaid insurance. Don't forget, prepaid insurance and prepaid supplies are assets. They belong on the balance sheet under current assets. Supplies expense and insurance expense are accounts that belong on the income statement. Okay, number three. A building was purchased for $690,000. Now let's go back. You see the head building, $690,000. With a 25-year life, useful life, and $5,000 residual value. In other words, this building was purchased for $690,000. The useful life was estimated to be 25 years, and the residual value was estimated to be $5,000. Residual value, scrap value, salvage value, same thing. In other words, after 25 years, the building will no longer be useful to you, and you'll sell it and probably get $5,000 for it. That's what that means. Now, it says 25 years, but we're calculating depreciation on a monthly basis. So, what is the depreciation expense? Let's do the calculation together. Take your calculator out right now. Pause this if you have to. Get a calculator. I want you to work this out with me. So, we have $690,000. Put that in your calculator. Minus the salvage value of $5,000. So that leaves us with $685,000, correct? Now we're going to divide that by 25 times 12. 25 years is what? 300 months. That's 25 times 12, right? 25 times 12 is 300. So 300 months. So we're going to take 685,000 and divide it by 300. And we get $2,283.33. You can forget about the cents, okay? So that's the depreciation for 1 month. And since you've only been taught straight line depreciation, this journal entry here, debit depreciation expense for $2,283 and credit accumulated depreciation by $2,283, you make that entry every month for 300 months. Excuse me. So, notice this. In the previous two examples, we credited the actual account, prepaid supplies, prepaid insurance. But when it comes to depreciation, we do not depreciate, that is, credit the building. We credit a separate account called accumulated depreciation. This is the entry you make. You debit depreciation expense and you credit accumulated depreciation. I repeat, accumulated depreciation is a contra account and it belongs on the balance sheet right underneath the asset that is being depreciated. It's a contra account. A contra account is an account that's linked to another one, but it always has the opposite balance. Accumulated depreciation has credit balances. Assets normally have a debit balance. Okay? And actually, well, anyway, there that is. Okay. Number 4, $18,473 of unearned income has now been earned. Let's go back to the previous T accounts. Let's look at unearned income. Under unearned income, we see that originally it was $29,208. In other words, they were given that much cash in advance. So you debited cash by that amount, right? And you credit unearned income. So that's how much unearned income there was, $29,208. So let's go to the adjusting entry. Now, $18,000 of that has now been earned. You've done the work and earned that much of the $29,000. You've earned $18,000 of it. So you're going to reduce this liability. Don't forget, unearned income is a liability. A liability normally has a credit balance. To reduce a liability, you debit it. So you debit unearned income of $18,473, and then you credit consulting services or revenue. Now you've earned it. So that's why you credit consulting services. You've earned it. Okay? So look at this very carefully. Okay? Of the $29,000 unearned, $18,000 has now been earned. So you're going to reduce that by $18,473, and then you're going to credit or increase your consulting services. Revenues, of course, have a credit balance normally. Okay? The last one here is, okay, let's walk through this. Payroll is $8,000 per week for a 5-day week. So and Friday is payday. So every Friday the company pays out $8,000 in payroll. Forget about taxes and deductions. We're just talking about gross payroll right now, okay? But the last day of the month, 31 May, is a Tuesday. So what does that mean, folks? Think about it. That means 2 days worth of expenses belongs to May. The other 3 days belongs to June. So we got to record 2 days worth of payroll expenses, in effect, belongs to May. So if it's $8,000 a week, that means that it's $1,600 a day, right? 1,600 times 5 is 8,000. So it's $1,600 a day. Monday and Tuesday those expenses belong to May. Don't forget the matching principle we talked about. We talked about the matching principle. Those expenses got to be matched against the revenue for May. Those expenses, those 2 days, do not belong to June. They belong to May. So 2 times $1,600 is $3,200. And that's what you see here. We're going to debit salaries expense, $3,200, and it becomes a payable because the company owes it. It has incurred a debt, hasn't paid it yet, so it's a salaries payable. But you will expense it for May. Don't forget, you record an expense when it's incurred. Under accrual accounting, you incurred this expense. Doesn't matter when you pay it. You may pay it, hell, in December, as far as that goes. I mean, it wouldn't be right, but still. The point is, you record it when it is incurred. And that expense, 2 days worth of expenses were incurred in May, so it's part of May's expenses. Okay, notice a couple of things here. You skip a line. Here I skip 2, make it easier to read, I guess. But at least skip 1 line when you're recording these, so it makes it easier to read the journal entry. Another thing I want to see, and I let it slide on exam 1. You add up all your debits and you add up all your credits. So let's type debit here and credit there, okay? Alrighty. I don't care if they're the same number. Sometimes they won't be, but the point is in terms of each side. And then you strike a balance. A double line underneath. It means that that's the total. Okay? Notice what I'm doing here. This way, if I made a mistake, if I had, for instance, if I had said $3,710 debit and $3,001 in credit, I would just transpose one number. I wouldn't catch it until I add up all the numbers. I said, oh, they don't match. So either I simply punched in the wrong numbers or I made an error, wrote down the wrong number. Okay? So you need to, at the end of every page, at the bottom of every page, before you go to the next page, if you're journalizing entries, you foot it. Or if you're in the middle, if you finish in the middle of a page, then you foot it then. Now, something to keep in mind. Here we balanced. If we did not balance, we know we made an error. But even if you balance, you still could have made an error. I mean, maybe the supplier's expense should have been $3,810. And you would have debited $3,810 and $3,810 credit. You would balance, but $3,810 is wrong. It's $3,710. So even if you balance, there's no guarantee that you did not make a mistake. But if you don't balance, you absolutely did. So now we have made 5 adjusting entries. Okay? Now we're going to post these numbers to the same T accounts. So, you see here, we're going to take supplies expense, and again, some of you make this mistake, but folks, if it's a debit in the journal, it's going to be a debit in the T account. Actually, the journal entry, I would argue, is the most difficult part because you got to get it right. You got to get this right. Beyond that, most of the steps are simply copying what you've done in the journal. And if the journal entry is wrong, that error will go all the way through to the very end. So this is where you need to really hone your skills. So let's post these to the T account. We're going to post a debit to supplier's expense of $3,710. So let's go to this here. You see supplier's expense. Where is it? Oh yeah, here. You see here, $3,710. We posted as a debit from the left side of the T account, and then we're going to credit prepaid supplies by $3,710. So let's go to prepaid supplies and look at the credit. Prepaid supplies. Here we credited $3,710, and we strike a balance. Debit. When you have a debit and a credit, you subtract, and whichever side was larger to begin with, that's what it is. So it's a debit balance. So now we know we have a balance of $1,893. That's what's remaining. And of course, that's what it said up here, right? Remember it said up here? That's what's remaining. Okay. Let's post our second entry. Insurance expense, we're going to debit that by $15,094. So let's go to insurance expense, T account, and we debit that $15,094. See that? And we credit insurance, prepaid insurance, $15,094. So let's go, let's see that. Prepaid insurance, we credit that $15,094. And that leaves it with a balance of $6,851 worth of insurance that we still have, coverage for. Then we go to our third one, depreciation expense, $2,283. And so let's go there. Depreciation expense right here, $2,283. And then we're going to credit accumulated depreciation, $2,283. Okay. Here's accumulated depreciation. We already have some in there because this is not a new building. You bought it, you bought it for some time. So far, you're going to add another $2,283 to the depreciation you've already accumulated. So now we have a balance. Credit plus a credit is another credit. So now we have a balance in the accumulated depreciation account of $66,258. Okay? And then we have the unearned income. We're going to reduce it with a debit, $18,473. So let's go to unearned income. You see, we had that much originally, $29,208. We earned $18,473 worth. So now our balance, we still have unearned income of $10,735. But we posted this debit is my point here. Okay? And then we will credit the consulting services of $18,473. So let's go down to consulting services. And there's the $18,473. We already had earned during the month $312,000. So now we're going to add another $18,000 to that. So now we have a balance of $330,529. And lastly, we have our salaries expense that was earned or incurred in May, $3,200. Debit to salaries expense. So you see that here, $3,200. So far, of course, during the month, $24,000 worth of salaries expense was incurred and paid. But now, this $3,200 was not paid. So it's owed, and you go up here. Let me see something here. That may be a typo there. Salaries, expense. Yeah, this is a typo here. It should be 3,200. Okay. Alrighty. Comma there. So this is the expense, debit the expense, and you credit the payable. So we now posted these journal entries to the T account. So now we go to account, and we're going to strike a balance, right? This is the balance here for each of these. Here we subtracted the credit from the debit, and you got that as a debit balance. Got a debit balance there. These are the balances now. Excuse me. These are the balances. Again, unearned income is now reduced to $10,735. These are the balances, okay? And folks, we are going to take these. Okay, let's look here at the worksheet now. These were the original entries that were already posted. These were the numbers that were already posted to the T accounts. Okay, they're already posted. These are the adjusting entries we made. Look here. We debited unearned income, $18,473, and we credited consulting services by that amount. See that? In fact, let's go ahead to the adjusting entries here. Let's look at supplies expense. We debit supplies expense by $3,710, and we credit prepaid supplies. Let's go look here under adjustments. Look, we debited, where is that? Supplies expense, $3,710, and we credited prepaid supplies. See, there was a debit on the T account. There's a debit in the. It was a debit in the journal entry. It said debit here, supplies expense. It was a credit, prepaid supplies. We credited here. In other words, we simply copy the journal entries. We copy the journal entries. And look at that total. $42,760. $42,760 here. We take these entries. We take these journal entries, folks, and we duplicate them on the worksheet. You copy these directly to the worksheet. Of course, you got to post them first and strike a balance. But my point is that you're going to take these journal entries and post them directly to the worksheet under adjustments. Study this. Study this. That's what you do. You simply, these under adjustment here, we've simply copied the journal entries. We debited depreciation expense, $22.83, and we credited accumulated depreciation, $22.83. Now on exam 2, again, this is the chart of accounts right here. Chart of accounts right here on the left-hand side. And they'll be in the proper order. Okay. Now that we've made the adjustments, we've recorded the adjustments, now we got to come up with an adjusted trial balance. The first trial balance is an unadjusted trial balance. Maybe I should write that in here. Let's see, unadjusted. And let me put the word trial balance here. And let me make the word trial there. This is an unadjusted trial balance, all right? We got the adjustments, and then we're going to have an adjusted trial balance. So let me put here, and let me make the word trial here. Adjusted trial balance, okay? Okay. Alrighty. Now, that's what we do here. Adjusting entries do not include cash, by the way. So cash is a debit. There's no adjustment, so we bring that debit over to the debit on the adjusted trial balance. We have accounts receivable, a debit. No adjustments were made, so we bring it over. Do the same thing with notes receivable. It's a debit there, so it's a debit here. But notice, look at prepaid office supplies. Here we have a debit of $5,603. We have a credit of $3,710 adjustment. Therefore, the adjusted balance is $1,893, which is the same balance here we find under the adjusted. See this right here, same number. Here we have prepaid insurance, start out with $21,945. We had an adjustment of $15,094. Credit, debit minus the credit in this case would be a debit balance of $6,851. Let's take a look here at accumulated depreciation. It's a credit here and a credit there. A credit and a credit is you add, becomes another credit. So $63,975 plus $2,283 is a credit also of $66,258. A credit and a credit equals a credit. A debit and a debit equals a debit, right? As you'll see a little later. Land, no adjustment, so we just bring it all the way over. I want you to study each of these entries line by line, folks, line by line. Here we have a credit, unearned income, and a debit. So debit and a credit, you got to subtract, and since the credit was larger, it's going to be a credit balance of $10,735. Salaries payable, you start out with none. You came up with a credit adjustment, so you bring it all the way over. Same with notes payable. Okay? Consulting services, a credit and a credit equals another credit, and so forth. Look at salaries expense, a debit and a debit. $24,000 plus $3,200 is $27,200. They're both debits, so you add. You go all the way over. And the adjusted trial balance should also balance. Look at the bottom here. Okay? The debits and the credits equal, because you're going to add up all your debits, and you're going to add up all your credits, and they should equal all the way through to the trial balance. Now, what we have are the last two major portions of the income statement, debit and credit. The next two columns are the income statement columns, debit and credit. What you do, you know that from consulting services on down to the last expense, they all belong on the income statement. They'll be in the proper order. Sometimes it's called revenue or miscellaneous revenue or whatever. You'll know. Right after withdrawal comes your income statement accounts. Income statement account. That's why I said earlier, you need to know automatically what belongs on the income statement, what belongs in the balance sheet. What makes it easier is that they'll be in the proper order. In your chart of accounts, you start with your balance sheet accounts and you end with your income statement accounts. So look here, under the adjusted trial balance right here, these are all income statement accounts. And all you do is bring them over. Don't change the numbers. If it's a debit on the adjusted trial balance, it's a debit on the income. See these debits here? You just copy them over and then the debits here. Exact same numbers and they're debits because they were debits over here. Look at these two credits here. Consulting service and miscellaneous income. You bring them over as credits. You simply copy. Folks, that's why after the journal entry, all you're basically doing, to a large extent, is simply copying. That journal entry is, I think, one of the most challenging aspects of the accounting cycle, because you got to get that right, and there's no copying there. You are, as they say, it's often called the book of original entry. So you see that. You see this right here? So we've taken these in the adjusted trial balance, we've simply copied them over under the income statement. Now notice this, as I've said before. Now you're going to add up all your debits and you're going to come to $80,248. And you're going to add up all your credits and you're going to come to $383,702. They don't balance, they don't match. Here's the rule. Remember this. Bring down the larger of the two numbers. 383,702, you bring it down right there. Now, what does it take to go from $80,248 to get to $383,702? You subtract the difference. $303,454. If you add that to the 80,000, you're going to get the same number here. Now they balance. What does it take? It takes that number, $303,454. And that happens to be the net income. These debits are expenses. These credits are income. Income, or revenue, rather, revenue are the credits. Revenue minus expenses, that's your net income. Okay, now let's go back to the adjusted trial balance. You see these accounts up here, all the way down to withdrawals. You simply copy them over, debits to debits, credits to credits, over here. All right? Okay, you see that? These are the exact same numbers on the adjusted trial balance. You just bring them over. Debit to debit, credit to credit. You copy them. Then you add up all your debits. You get 1,167,603. You're going to add up all your credits, which is 864,149. You bring down the larger number, 1,167,603, and then whatever it takes to get from 864,149 to get to 1,167,603, you add that. And it should match what you did on the other side. If it doesn't, you made a mistake. These numbers match. See that? They match. Now, what this represents a net income. What if it's a net loss? What if it were a net loss? In other words, your expenses were greater than your revenue. Well, you see these two cells in the middle? Now, I color them as yellow right now. The losses would be in these two. These other cells on the outside would be empty. And the losses would be in the inside here, which I've colored as yellow. And they would also match. It'd also be the same number. If the loss is $500,000, then you'd see $500,000 in both of these cells on the inside that are colored yellow right now. But folks, do what I just asked or said. Add up all your debits for the income statement and all your credits. Whichever is larger, you bring that number down. And then you got to add the difference to bring the smaller number equal to the larger number. And so hear my words here. Hear my words. If it's a loss, that means your debit's going to, on the income statement, your debits are going to be larger than your credits. And if it's a loss, your credit on the balance sheet will be larger than your debit. And thus you got to fill in these two yellow boxes. Okay, now what we've done, we're not finished. Now we're going to have to generate financial statements. And folks, all you do is copy. Look here. On the income statement, this is your income statement right here. These are your credits, your sales, your revenue. On the credits here, $330,000 and $53,000, and these are your expenses. You just copy them. Let's just go to the financial statements, and let's go up here. Look, we got consulting services, came right off the worksheet on the credits. And technically, miscellaneous income should be after, but if you include it up here at the top, I wouldn't be mad at you for right now. So these are all the expenses that came off the worksheet. Every single number here came off the worksheet except for the balance, except for the totals. You added these up, and then you take that. You take the 330,000 minus 80,000. You get the operating income of 250,000. 280. Then you add the miscellaneous income, and you get 303,454, which is the exact same number that came off the worksheet. Go back to the worksheet, and you'll see where these numbers came from, folks. Keep in mind, this is called a multi-step income statement. I want to see the name of the company. UGMO, in this case, is UGMO Consulting Services. The month ended. It's an income statement for the month ended. I want to see that heading. You're not going to leave my class and go to another one not knowing this, how to construct a multi-step income statement. Here it is, folks. This is what I expect to see. Okay. Now, again, as you've learned before, now you're going to prepare an owner's equity statement. Well, the owner capital came off the worksheet. See that? Let's go back to the worksheet. See that? Owner's capital, $709,000 right there. That's the capital. Right there. We add the income. This $303,000 from the income statement goes right there. And we're going to subtract the withdrawals. The $59,334, let's go back to the worksheet. There it is, $59,334 off the worksheet. And then we come up with a new balance. Don't forget you subtract the withdrawals. And withdrawals do not belong in the income statement. Let me say that again. Withdrawals do not belong on the income statement. They belong on the owner's equity statement as a subtraction. Now, if we had incurred a net loss, we would subtract it from the capital. You subtract net losses, you add net income, but you always subtract withdrawals. So this is the new capital. This is the new capital, $953,554. Then we're going to construct a classified balance sheet, folks. Study this. This capital, I'm going to put it this way, every single number on this balance sheet, every single number came from the worksheet except for your totals and the owner's equity. The owner's equity comes from the owner's equity statement. Okay? But all the other numbers, except for the totals, came directly off of the worksheet. Go back and check if you don't believe me. Now notice this. Our assets are divided into current assets, PP&E, property, plant, and equipment. PP&E stands for property, plant, and equipment. In the olden days, they called it fixed assets. But PP&E is a more common term. Notice there's an accumulated depreciation. It belongs on the balance sheet, and notice it's in parentheses. That means that you take the building, $690,000, and subtract what depreciation has been accumulated already. And you add land, and you're going to get then the total of $894,842. And so your PP&E plus your total current assets equals $1,042,011. Study this. You need to know this format by heart. You need to know this format by heart. This is a classified balance sheet. Notice you start from the most liquid on down. Cash is the most liquid. Liquidity means convertible into cash. It's easier to convert accounts receivable into cash than, let's say, prepaid insurance. I mean, you're not probably going to get your money back, you know. Then you go to your assets that are property, plant, and equipment that are fixed. Building. You do not depreciate land. 99.99% of the time, you do not depreciate land. Land is only, when every textbook will say you don't depreciate land. There is a highly, highly rare and unusual time when you would. So the 99.9999 times percent of the time, land will never be depreciated. So for all intents and purposes, you don't depreciate land. And then look at then you got, so here's our assets. Now, let's take a look at the current liabilities. And all the liabilities here are current. Sometimes you're going to have long-term liabilities. Long-term liabilities are liabilities that takes longer than a year to pay off. But all these are payable within a year, so they're all current. Okay? You total them, and then this is your new owner's equity right here that came from the owner's equity statement. So your total liabilities, okay, plus your owner's equity equals the same as your total assets. Because don't forget, the first day of class, what was it? Assets, right here, equals liabilities plus owner's equity. Same number. Now we're not finished. We got two more major things to do. Okay? So we have generated the three financial statements. Now we've got to close our accounts, some accounts. Remember we said that temporary accounts, you close temporary accounts, you never close permanent accounts. You know, unless you're liquidating the business or whatever, you know. But you do not close permanent accounts. And every account here on the balance sheet is a permanent account. I'll say that again. Every account on the balance sheet is a permanent account. You do not close them. All other accounts, such as all your income statement accounts, plus withdrawals, and a new account called income summary, which we talked about on the slides. Let's go to closing entries. Notice this. Expenses usually have, let me write this up here, debit, so you see that. Okay. Yeah, that'll work. Now you close them with journal entries. Journal entries, which you will also post. I don't show the posting here, but you would post them also. In this case, I won't ask you to because, well, for the sake of time, basically. The normal balance for expense accounts are debits, right? Right? So to close them, you credit them for the same amount of their balance. If you go to the worksheet, you will see, or go to the T account, you will see $27,200 debit under sales expense. To close it, you would credit it. In other words, you do the opposite. To close an account that has a debit balance, you credit it for the same amount. which brings it to zero, right? If you have a debit balance of $80,000 and you credit it for $80,000, the balance is zero. You've now closed that account. So you're going to credit all of these expenses. What are you going to debit? You add all these up, and you come to $80,248, and you debit it. You debit income summary. You debit income summary. So you credit the debit balances, which are all your expenses, and you debit the income summary. You do the opposite for your revenue. Your consulting services and miscellaneous income, they normally have a credit balance. So to close them, you debit them for the same amount, and then you would credit income summary. In other words, you use income summary as a conduit to close an account, to be the opposite side of the transaction. If you have a debit, you got to have a credit. At least one credit or at least one debit. Okay? So you close your revenue accounts, consulting services, miscellaneous income, with a debit, and you credit income summary. Now, if you would draw a T account, maybe I'm able to do it here. I'm going to draw one while I'm here. Yeah. Can I do it? Yes. It's a T account. Let's call this T account income summary. So right now, we have a debit balance of $80,000. Yeah, that's as a debit balance. And here we have a credit balance of $380-something thousand. If you were to post these, which in the real world you would, this is what the income summary looks like. Okay? Now we've got to close the income summary. What's our balance? Well, let me do this. Our balance is a credit balance, what? Of that's our credit balance. The net income. The net income here. And to close it, we're going to debit it by the same amount. And now it's a zeroed out balance. And that's what we did over here with this journal entry here. We debited it. We had a credit balance, right? We're going to debit it by $303,000 and credit owner's capital by $303,000. By the way, if it were a loss, then the debit side would have been larger than the credit side, right? And you would have had to then debit owner's capital and credit income summary. Think about that, folks. If it were a loss, you'd be doing the opposite. You would be debiting owner's capital and crediting income summary. Because income summary would have what? A debit balance. And then the last account that you would close would be withdrawals. You do not close withdrawals through the income summary. You close withdrawal directly to the owner's capital. So withdrawal has a normal balance of a debit. To close it, you would credit it. That zeroes it out. And then you would debit owner's capital. And again, notice these. These are journal entries, folks. And look, you strike a balance. You foot them. Make sure your debits equal your credits. Okay? I want to see that. And then the final step. The piece de resistance, I think they said, or the coup de grace, or whatever you want to say it. We're going to construct a post-closing trial balance. So we would have done 3 trial balances. Unadjusted trial balance, adjusted trial balance, and a post-closing trial balance. The word post means after, right? You learn that in Latin. Post. Anyway, it means after. So after closing, we have to generate a trial balance. And notice this. These are all the accounts on the balance sheet. You have your debit here and your credit there. You must balance. Notice, even though these are all the accounts on the balance sheet, this is not a balance sheet. It's not constructed like a balance sheet. You have your debit accounts and you have your credit accounts. And don't forget, accumulated depreciation is a credit, and you do not subtract it here. No, you add that $66,000 to the rest of these credits here. Accumulated depreciation is a credit, just like these are all credits, and you add up all your credits. Look at this. This is a post-closing trial balance. And they match. Debits equal credits. I want to see that. So now what I've effectively done is shown you pretty much what exam 2 is going to be. If you have any questions, feel free to email me. I hope this has been very straightforward and clear to you. The exam 2, I forget when it is, it'll be pretty similar to this, maybe not as many accounts because you only have a limited time. But I want you to be prepared for it. So, and I've effectively gone over chapters 3 and 4. This right here, we've effectively done chapters 3 and 4. Anyway, be safe. Take care of yourself. Have a happy day and whatever. And hopefully, again, if you have any questions, please feel free to contact me. Take care.